All right, Brad, thank you. All right, everybody, Orlando, Nick, Joshua, Jeff, Carlos, Brad, Wade, Tom, Sally, Paul, and Paul S. Alpha, Amos. All right, so we have a few people here in the room. This webinar this morning is live, so I don't do any pre-recorded webinars. And my goal here is to show you a few things, teach you, show you the software, show you the Atlas line and the trade scalper, see if the way that we trade and the way that I like to teach price action is right for you. If you have any questions, you can always email us by the contact form here or support@daytradetowin.com. You can call us. Also, if you haven't visited daytradetowin.com, there's a lot of information here on trading, right? So, for example, if you're interested in downloading some free software, you can download the indicator. The news indicator. We offer it as a trial for free. It's right here, a free news indicator for NinjaTrader, and we have a couple other things here. I think it's important to understand when news events come out. So you have an online news calendar, which is a link to a calendar online. Bar timer for TradeStation, take counter for TradeStation if that's what you're using. My preference is NinjaTrader, but there's a few things that you could look at and download. And we also have a lot of videos here under video section, trading videos, where if you'd like to look at the most recent videos, we have here hundreds hundreds of videos, all recorded live for you to review. And we have a blog as well. So there's a lot of information here. The blog usually provides updates on rollovers and holidays and things you should be concerned with as traders, links to all the social media and so on. So we do offer a lot of information here, and we have the courses page as well. The next mentorship class is starting November 2nd, so those of you who are interested, November 2nd includes all the courses and the software. So my name is John Paul. I'm the founder of Day Trade to Win, and today we're going to look at orders and the software as well, but really trying to understand how to place orders correctly. All right. And so this is interactive. If you have questions, I invite you to ask questions, and even after, you can email me any questions that you have through the Contact Us page. So before we begin, remember that trading is risky. The disclaimer, as always, trading is not for everyone. Please remember that you should understand the risks involved with trading. So just be careful when you start trading. I recommend everyone begin practicing, so you can download the NinjaTrader charting platform directly from NinjaTrader or from us. Get a live data feed if you need one, and start practicing. So before you trade live, practice, and then once you're ready, you can start with the micro E-mini, or you can start with one E-mini S&P. Take it slow. All right, so everybody should be able to hear me. Orlando, can you hear me okay? Testing 1, 2, 3. All right, so what we're going to do here is look at the type of orders that exists. And besides the signals that you see here showing up here on the chart, which I think is a good representation of the Day Trade to Win trade scalper, the Atlas line, and so on, what I want to do is first look at the dome here. This is called the dome, the depth of market. It's also called the price ladder. And when you look at the prices moving up and down, the way that we're going to approach this is to look at whether or not first you want to use a market order, whether you want to use a limit order, or whether you want to use a stop order into getting yourself as a buyer or a seller into the market. So there's typically 3 different types of orders that you can place when entering into the market. So a limit order basically says, I want this exact price or better. That's really what a limit order does. So if you were going to go short at 34, 35.50, the only way to get this exact price or better is by placing a limit order. So on the sell side, this is the sell side over here. If you can see, the right hand column is the sell side. The sell side Anywhere above where the market is trading, this is where you would place the order. So if I left clicked here, this would give me the option for a limit order or a sell with a market if touched. And I'll go over both. So if I left clicked here,
Order filled.
this is considered a sell order up here.
Target filled.
If I wanted to buy the market, I would have to buy it on the buy column, and here on the left hand side, anywhere below where the market is trading, this is where you would place your limit order or your market if touched order. So remember, if you're selling the market on a limit or a market if touched, always sell it above where it's currently trading. If you're buying the market with a limit or a market if touched, always below to where the market is currently trading. So you would have to left click here and say, do you want to sell limit at this price, whether it's the E-mini or the NASDAQ and so on. Okay, good, Orlando, thank you. Is based off of the market that you're trading, and you can adjust it. So I have different markets working. I have about 6 monitors on this computer, and some monitors are using the NASDAQ, some monitors are using the E-mini, and you would definitely have to adjust here the instrument based on the chart that you're trading. So if you do want to have multiple price action ladders or domes, or what you see here, the price here moving up and down on this depth of market, you would either have a second dome or you would adjust it here in the same way, right? So depends on really how you want to look at it. Typically, if you have just one dome, one of these domes here, it works the same way: limit order, market order, above where the market is trading, below where the market is trading. Same thing here. You would left
Order
click
submitted.
for a limit, above to sell, or
Order canceled.
left click below where the market is
Order submitted.
to buy. Okay, so first let's make sure we understand the limit order process is I want the market to retrace down to this price, or I want the market to retrace down to or up to this price.
Order submitted.
So it depends on if you want to be a seller, the market has to come up. If you want to be a buyer, the market has to come down. Always think of limit orders
Order
or market if
canceled.
touched orders
Order
in that
canceled.
way. All right. So Orlando, Brad, Jeff, this understanding of a limit order is always a retracement. The next thing is the type of orders that you could place, market if touched as compared to a limit. So a limit order will only fill you at this price long or this price short or better. It won't fill you at any other price. Sometimes you can get a better price, but it won't give you slippage. A market if touched uses the same process. You still have to place an order below where the market is trading, but a market if touched, the difference is that it
Order
says
submitted.
when it touches this price, enter directly at market regardless of the price you get. So you have slippage typically. Sometimes it's in your favor, not always. So a market if touched basically says if it touches this order at this price, just get them in. I want to go long at this price.
Order
And the same thing is
canceled.
true if you want to sell the market and use a market if touched.
Order submitted.
You would say, I want to enter at this price. Just get me in. It doesn't matter if there's slippage. I just want to be short at this price. So a market if touched has its advantages because you immediately enter. You don't have to wait for an order queue. You get filled instantly. The disadvantage is you could have slippage. So MIT and limit order are placed in the same way. Left click either above the market to be a seller or below the market to be a buyer.
Order canceled.
Now you can alternate between the two, and I do as well, by holding down the control key. So on NinjaTrader, it varies on different charting platforms, but on NinjaTrader, if you hold down the control key, you can switch between a limit
Order submitted.
and a market if touched.
Order submitted.
Okay, so you have the option of using one or the other. Now what you're seeing here is called the chart
Order
trader.
canceled.
And the chart trader,
Order
even though
canceled.
I personally don't use the chart trader exclusively, I like to have it turned on just so I can see where the signals and my orders are being placed. So you can see that when I do place a market if touched order, for
Order
example,
submitted.
it shows me on the chart and it shows me on the dome the exact same price and placement. All right, Joshua, just send us an email if you have any issues with getting a data feed for instruments. It's not, the data feed sometimes doesn't work with all instruments, but just send us an email, okay? And if you place a market if touched order
Order submitted.
or a limit order, the market has to come back to fill. So it's very simple. You're waiting for the market to come back to fill you. Now this can be moved around like this, just like we can move them around on the dome. So this can be moved around either on the chart trader or on the dome. And it makes it a little easier to move your targets and your stops if you have to. And remember, if you do want to get filled, all you have to do is click on it and place it where it's currently being traded or just above. And that way it instantly fills you. What you're saying is, I'm not going to wait for this price. I want to be instantly filled. So you can move these around anywhere you want. So you are able to move these prices as you see fit. All right. So if anyone has any questions as we go over the limits and market if touched and how to place these orders,
Order canceled.
let me know before I continue. All right. So the first order that we see, market if touched or limit. The next order is what we call a stop order. And a stop order, what you usually hear is a protective stop, right? So you enter into the market and then you have some type of protective stop. So a stop order is just an order. It could be used to enter into the trade or it could be used to get out of a trade. But remember, it's just an order. So if you wanted to place an order on a stop, it's called order on a stop, to go long, the way that it works is that you're placing the order in intention as the market goes up, you want to be filled here. So remember, a limit order or a market if touched is always a retracement, right? You want to see it retrace down. This here would be a limit order or a market if touched,
submitted.
right? We want the market to retrace down to this price as an example. But a stop order doesn't work that way. A stop order, you want to see the market go in the same direction. So let's say that I wanted to buy on a stop at 34.48. So I would come up here. On the left hand side is the buy column, and I would use the middle mouse button and I would click down on the middle mouse button. This is the middle mouse button. Your wheel, your scroll wheel, is actually a button, and you can press down on it, and that would be the way to get into the market on a stop. All right, so the same thing, if I wanted 34.49, right, so I don't get filled here, 34.49, I click on that middle mouse wheel and I say yes. So now we have an opportunity to go long as the market goes in the same direction up. So that's important to understand the difference between what a stop order does. It's just an order. And so most traders, when they think of the word stop, they think of protection. And it is used as protection, but it's just a type of order that exists. So the best way that I can explain that to you, especially for the new traders, is that let's say that you went long the market. So I'm going to go long. I'm going to place an order here, a limit order to go long, and I'm going to force a fill. So you can either move this to get filled or put it right there, and now you see one contract long. Okay. Now once you're long, we have to protect ourselves with a stop, right? In case the market goes against me, I want to protect myself. So on the sell side, we're going to use a stop. Again, it's the same thing. As the market goes down like this, we want to protect ourselves with a stop. So as the market goes down, remember the sell column is the right side. As the market goes down, we're going to have a stop. So again, it's the same type of order. It's a stop order, but this time we're using it to get out of a trade as opposed to getting into a trade. So remember, a stop order is just a type of order that as the market is going in that same direction, you're getting in or you're getting out. So it depends on how you're completing the round turn. If you're entering for the first time on a stop or you're exiting, you're current trade on a stop. Anyone have any questions on that? How that works? All right. So let me just close this out.
Order
The same thing
filled.
if I wanted to be a buyer. So I'm flat, the word flat, I click down here and it says buy stop market
Order
like
submitted.
that. That means I'm entering for the first time. I'm flat. I want to enter long to go long as the market hits this price and continues. And once that happens, I will then put a protective stop here. Again, it's just a stop order on the sell side in case it goes against me. All right, so the distinction here of a stop order and a limit order is really where and how you place the trade. You can only place stop orders above to be a buyer or to be a seller as it goes in the same direction. For limit orders, though,
Order
it's different.
canceled.
It's always a retracement. A limit order like this,
Order
or
submitted.
market if touched, or like this.
Order
Right,
submitted.
so we want the market to come down to fill us or to come up to fill us on a limit or a market if touched. It may be a little confusing at first
Order
when
filled.
you see this for the first time, but with practice and with an understanding of what the orders are trying to accomplish, it really does help you with on the spot, at the moment when you're about to place a trade, you need to know what to do. So for example, the entry long at 34.48. So I see this is green. That means I'm long one contract. This here, if I keep it here, it would be a profit target. As the market goes up, I'm selling it at a profit, MIT or limit, right? It's retracing up to sell it. But at the same time, if I click the middle mouse button down, it
Order
would be
submitted.
a protective stop. So it goes against me. It's going to stop me out. All right. So for example,
Order
this
filled.
trade here, 34.49. If we are going to analyze this trade here on the trade scalper. So 34.49 is the entry. So 34.49 right over here is where I want to be filled.
Order filled.
And so I'm filled at 34.48.75. So this is where I'm filled, 34.48.75. I got filled. You could have gotten filled on a limit or a market if touched or a stop. Now, once you're filled here at 34.49, 34.48.75, and remember, I'm just using the Trade Scalper software. Once that happens, you say to yourself, well, what is the target on this trade? Well, if I look down here at the ATR, this is very important. I have hundreds of videos that discuss how to use the average true range. It tells me that 2 points or 2.25 points is what the next candle could do. So that should be a target that you want to achieve. Not 1 point and not 10 points, but roughly what the market could achieve. Now, at this point, the market has already moved the 2 points, right? So 51 would be the 2 points. It's at 51.75, right? So you're going to come over here and you could left click
Order
to
submitted.
get out of the trade once it hits this price or this price or this price or this price. And at the same time, a protective stop, middle mouse button down,
Order
like
submitted.
that. Now, you don't have to wait for this to reach your target if after a certain amount of time, I'm big on time-based stops. After a certain amount of time, if you do want to say, okay, let me get out of this trade. It's in my favor. I'm making some money now, or I'm losing some money, but I want to get out of this trade. There's a couple of ways that you can get out of a trade as well. So one of the ways you can get out is by moving this limit or this market if touched to where the current price is trading. So even though you can move these around, you can get out of the trade
Order
like
filled.
this. Or if you want, you can move the stop up also to get out of the trade. But since I'm already out of the trade, I'm flat, I don't want to move my stop. I just want to cancel
Order
it because I'm
canceled.
already out of the trade. So just to review what you're seeing here, and there's actually 2 orders here to go long using the Trade Scalper. One with both of these little arrows here, 34.49 and 34.49. They're actually, it's 2 separate orders the Trade Scalper provides. They're actually on 2 different candles, and they're both at the same price to go long. But regardless, if you look at the target of about 2 points, 2.25 points, that would be your target. All right. That would be your target. Any questions so far? So that trade scalper signal to go long hit the 2.25 or 2.5 points that I would say be a little bit more conservative, to about 2 points, 2.25, and you're finished. You're done. You're looking at the next trade. All right. Anyone have any questions on the way that we placed orders? Now, I did this manually. I did not use the ATM strategy. I did it manually. I placed the order, I got filled, and then I placed the target, and I placed the stop. All right, not too complicated, but again, especially if you're new to trading, it's so easy to make mistakes, especially if you're doing this on your own, that I encourage you to practice and ask questions. The traders that I work with, some of them are very experienced, where they know all the basics, and other traders are new, and so I have to spend a little bit more time explaining the basics, making sure that you don't make the mistakes where you're at the heat of the moment, you're clicking buttons, and it's very easy to get mixed up on it. Now, the NinjaTrader charting platform does offer a benefit with what's called an automated type of exit strategy. Now, automation is good, but it's also sometimes bad, because when you try to automate things and then you want to adjust them during the moment, it sometimes creates a problem. You can't just change things after it's already started the automation process. So I recommend keeping the automation for the ATM strategy very simple. I recommend using, for example, this ATM strategy down here. If you start off with a custom target and a custom stop, say that you just want to have in ticks, not points, but in ticks, because ticks is the smallest increment any market could move. So in ticks, let's say that you want a stop of 8 ticks and you want a profit target of 8 ticks. That means that when you place the trade, it'll create a target and a stop of 2 points on the E-mini, which is 8 ticks. So if I entered at market, one of the orders is just at market, get me in, or if I used a market if touched,
Order
or if I
submitted.
used a limit,
Order submitted.
as soon as I get filled, it'll create a target and a stop for me.
Order
So
canceled.
if I move this up in order to force the
Order
fill,
filled.
you can see that it automated the targets and it automated the stops. Whatever values you have configured, and you can create templates as well. So you see over here where I've created, and I showed this to people and to my students all the time, 1 point target, 10 ticks, 2 point, 2.5. When the market's more volatile, 20 ticks, and so on, scalping for 1 point. And you can create these and save them. So it creates the target and it creates the stop for you. You can still move them around. There's no problem with this moving up or down. So that's not an issue whatsoever. But if you wanted to add contracts, and if you wanted to change quantities, and if you wanted to do a little bit more, it's not going to let you, because you started out buying one contract and it automatically created one exit and one stop. So trailing a stop and doing those kind of things is possible, but it complicates it when you try to automate the exits like this. So I recommend keeping it very simple, right? Trading doesn't have to be complicated. Keep it simple. Have the ATM strategy with target stop, and then if you want to cancel the trade, you come here to the close button and you just
Order
close out
filled.
the position and you're done. Anyone have any questions? Right? Not complicated, but it does take a little bit of practice to make sure you don't make any mistakes. The other type of order that exists, which some of you may have seen, it's called a stop with a limit. And a stop with a limit is basically a type of order that is used like a stop, but you're limiting the amount of slippage. So if I just entered at market, I have to expect there may be a tick of slippage. So if I bought at market here, right, do you want to buy at market? Whatever price this happens to be isn't necessarily the price you're going to get. You may get a tick more, you may get a tick better, but when I click this,
Order
it
filled.
just gets me in the market. And the E-mini and the NASDAQ, they're liquid enough where you get the price that you want, or off by a tick. So it's normal. And then you see the target and the stop is placed automatically. because I had the ATM strategy here.
Order filled.
But what if you wanted to limit that type of slippage when it comes to using a stop order, right? So let's say that I wanted to buy on a stop,
Order
and
submitted.
once it hits the stop and it converts itself into an order to buy at market, you don't want to have any slippage. So that's where the stop order with a limit, it's called stop with a limit. And you've probably seen it if you've messed
Order
around here
canceled.
with NinjaTrader, where it looks something like this, with this little box like this. So what this is telling me is that I want to enter long once it hits this price. So again, it's going in the same direction, moving up, and I want to get filled as it goes long and the market goes up. This 0 here is not number of contracts. The number of contracts, the quantity, is already listed down here. This 0 is indicating what you would like to be filled on with how many ticks of slippage you'll allow the system to get you in. So for example, if I said 1, it means that I want to get filled at this price, 53.25, 34.53.25, or 34.53.50, but nothing else. If I can't get filled within these two prices, then don't fill me. All right? So if I click yes, it says you want to buy in a stop with a limit with 1 contract. I click
Order
yes,
submitted.
and stop it can't be placed below the market because the market's moved already. It's above where I was going to place the trade, like so.
Order submitted.
So now, if I wanted to get filled at this price and I used 1 tick, 1 is just the number of contracts, but I used 1 as the number of ticks that I'm allowing to get filled. So once it hits this price, I can get this price or that price. If I used instead
Order canceled.
5, it means that I'm willing to get filled anywhere within 5 ticks of this price. If I can't get filled within 5 ticks of this price, then don't fill me. So if I click accept,
Order submitted.
this is the price that I want, but within 5 ticks of this, that's where I want to be filled. So you're limiting the amount of slippage and telling the system what you want. Now you may ask, well, what if I
Order
just want
canceled.
0? I don't want any slippage. Sure, right? So if you click this here and you say, I don't want any slippage whatsoever, no slippage whatsoever, that means
Order
when the market
submitted.
hits this price, what you're saying is all I want is this 34.57.50. I don't want any other price. If you can't give me this price, if the market's too fast, if there's not enough contracts there allowing me to get filled, then don't fill me. So really what you're indicating is that you're not willing to give up any other price except for this price. So you're limiting the amount of slippage. So that's what's a stop. That's a stop with a limit. It's placed in the same way, and how you alternate between using a stop with limit or just a regular stop
Order submitted.
is by holding down the control key on your keyboard and then middle mouse button down. So the same way that I use an MIT or market
Order
of touch
canceled.
to alternate between a limit
Order
or
submitted.
a market of touch is
Order
by holding down
submitted.
the control key and then left click. This here is the control key and middle mouse button. So if I wanted 1 tick of slippage,
Order submitted.
or I just wanted a plain
Order
stop,
filled. Order canceled.
like so.
Order submitted.
So that would be a stop order, and that's a stop with a limit. This is a market if touched or a limit. Let me close this out.
Order
All right, so
filled.
for the Atlas line trades, the first Atlas line trade here was a short here, 34.49. This trade did not go in our favor. 4 candles later, 1, 2, 3, 4, you're out of the trade. So we use a time-based stop when exiting the trades instead of just a hard stop. That way it limits the amount of trades that we're in. The next trade is a long on the Atlas line. This would be going long here, and if the target is about 2 points right over here on this trade, then I'm looking at 2 points, and the market moved a little bit more than 2 points, 2, 2.25, and so that target was achieved. If this target isn't achieved on any of the trades that I teach, I limit the amount of time. I don't like to hold on to signals or trades that are hours on end. If there's a reason to go long, whether it be a scalp trade or an Atlas line trade or at the open trade or roadmap trade or whatever method that you're using, limit the amount of time. We should see an immediate goal reached in a short amount of time. If not, we have to move on and cut our losses with a smaller loss. Any questions? Terry, Sally, Prince, Paul, Orlando, Nick, Jeff, Alpha, Brad, Chris, Dennis, everybody else. Just to give you a little bit of a relationship between making that profit or that goal in the shortest amount of time possible and not holding on to it as it goes further against you. Joshua says, okay, time frame. The time frame that I'm using here is a 1 minute chart. If you wanted to use a 5 minute chart, you could. So I'm just going to switch here to a 5 minute chart. And let me just remove some of the things here that I drew on the chart. Now you may ask yourself, what is the difference between using a 5 minute chart and a 1 minute chart? And the difference at this point is risk, Jeff. If you look here at the ATR is above 5. Usually when the market is more volatile, we have higher risk. So there's an extreme that I tell everyone is that if, and this is just for the E-mini S&P, but you have to configure it for other markets as well. It's different for the NASDAQ and for the Euro. But if you look at the E-mini S&P as an example, if the market is trading above 5 points, here, above 5 points, to me, that's higher risk. That means every trade that I take has a larger stop, more than 5 points that I'm willing to accept. And therefore, I don't want to trade with such risk. I tell everybody, drop it down to a 1 minute chart where the ATR shows you a smaller value. So you have a smaller stop. And the target's also smaller, but that's fine. We're in relationship. The higher the volatility, the larger the stop, the larger the target. But I think it's unacceptable to risk so much on each trade. And that's why I like to look at a 1 minute chart only if that ATR is above 5. And we also have a minimum. The minimum is 1 point. So if the market is trading at about 1 point or less, that means that every candle that you're seeing here, every candle is only going 1 point up, 1 point down, 1 point up, 1 point down. And I think that the market is typically choppy and whipsaw under slower conditions, and I don't want to trade. So there's extremes that you have to take into account when trading, whether or not it's too risky or it's too slow. All right. Jeff, let me know if you're okay with that. If you have any questions on the time frames and why you would use one over the other. Thanks, Brad. Appreciate that. Oh, I see. How much time do you allow for to get filled? Well, if you place an order to get filled and it's, let's say, 2 or 3 candles later, you're still not filled, I would say you lost it or you missed it. There's a couple of things that you could think about when you look at getting filled and the amount of time. So the first is obviously you don't want to wait an hour to be filled, right? So that's not really the goal. So if you have a signal, for example, let me see if I can show you an example. I'm going to go back in history here just to give you an example of where you may be waiting to get filled like this here. Okay. So this is at 1 o'clock in the morning. It's pre-market. And this 34.4850 to go short. Or even this one, 34.53. Actually, this is a better example. If you entered short at 34.53, great. You took this down, fantastic. But what if you weren't able to get 34.53? You placed the order to go short at 34.53, which is here. And instead, the market ran away from you. How long are you going to wait for this before you cancel the order? Well, I don't think you should wait this long. This is already, we're talking about at least 10, 15 minutes into this. It's too long. So the first thing you have to think about is how long you want to hold a position before canceling it because you weren't filled. And in this example, I don't think you should wait more than 10 minutes and get out of the trade. it's not benefiting you just to hold on to it and hope it's going to come back to fill you. That's the first thing, time. I would say 10 minutes. The next question is, what if the market runs away and it has already made the profit? Well, at this point, if you look at how far the market has moved from here to here, it's moved 3.5 points away as if the trade is finished. It's already completed the goal. I would not enter into the trade. So that is also part of how long do I wait. It's not just how long do I wait to get filled. It's also, has the market already made that goal, that profit target, and now I'm trying to see the market do the same thing twice or 3 times, and you shouldn't do that. So if the market has already made its goal, 10 minutes has passed, I would say cancel the order. There's no reason to try for the price to do 2, 3, 4 times in a row the same thing. So it's a combination, Jeff. Making sure I got that question. It's not just time, but it's also, has the market made a distance or the goal. All right. Now in a situation like this here, 34.48.50, 3 or 4 candles has passed, so 10 minutes really hasn't gone on yet. And how far has the market moved from this price? If the market's moved and made a significant distance, 2.5 compared to the 3 ticks on the ATR, I would say to you, look, it made the move. We missed it for whatever reason, or we couldn't get in, or the market was too fast. Let it go. Look how many signals we have. It's not so much that we want to take every signal. We just want to make sure that we get the signal right. We enter right. We take our target or our stop in the right way, and then we move on. So we have a lot of signals. You don't have to take every signal. I'm a big believer of trading less but trading more accurately. It's not going to help you if you trade 100 times a day and nothing to show for it. It's better if you trade 4 or 5 times a day, really good signals, you're up and you stop. All right. So for example, this trade here, 34.55 quarter, this trade, if you were able to enter on the very next candle short, you're fine. Market may have not done anything, right? It's flat. And if you remember, when the market is slow, look at the ATR over here. It's less than a point. So you're going to see this kind of whipsaw and flat environment. I already know this is not a good time to trade because the market is going to chop around a tick or two up, a tick or two down. So that's not going to help you as a trader. But as far as getting filled, Jeff, to answer your question, the very next candle filled you here, 34.55 quarter, if you didn't get it right away, and that's fine, right? You're still within reason to get filled. But I wouldn't take this trade. The market's too slow anyway. And I know the market's too slow. The ATR tells me that it's too slow. All right. All right, let's take a look at what's happening currently. And the type of, let me just remove here some of the things, the arrows and things. Another thing that you could do here with the trade scalper is entering the market not by using a 1-minute chart, but by using a range chart. And the other question is, well, how do I know when to use a 1-minute chart compared to a different type of chart? Renko, tick chart, volatility chart, range chart. Well, again, I have to say that depending on how slow or how fast the market is, it's in your benefit to use a specific type of chart. When the market is fast or when the market is volatile, a range chart or a tick chart is very hard to trade because the candles are moving so fast. There's so many transactions and the market jumps around. Before you know it, the move is over and you can't get in. So it's not a benefit to you to trade with that type of a chart under a volatile market. If the market's slow or normal, yes, a range chart or a tick chart works best. And so if I changed here, not best, but it works just as good as a minute chart. So if I choose here a 2-range chart, which is my recommendation, a 2-range chart, you can see that the ATR is not going to be needed because it's just 2 ticks on every candle. And you have here the signals on a range chart with the Trade Scalper software indicating short and long. And so, for example, this here earlier at 10 o'clock this morning, this signal here told you to go short. The very next candle or two got you in short, and away it went. So a range chart allows you to get in a little bit quicker, a little bit faster, but it's hard to trade if the candles are moving so fast. So just look at the ATR on a minute chart or a 5-minute chart, and you'll know immediately whether or not you're able to even get in under a fast environment. So for example, this 34.55 quarter, the next candle or the next candle or the next candle all got you in into this trade, and then away it went. Sometimes the signals are similar. Sometimes the signals are a little different than a 1 minute chart. The algorithm calculates it a little bit differently. The range chart is based off of distance, not time. The 1 minute chart is based off of time and distance. So there's a little bit of calculations that makes the signals different. I like to use, Jeff, a limit order when it comes to trading the range chart to avoid slippage. So that's a good question. A limit order will get you in without slippage, especially if you're scalping, because we don't want to give up a tick, right, every time we enter long or short. So there's a benefit to using the limit order. There's no slippage. Now, if you're going for larger profit targets, so for example, if I switch here to a 1 minute chart, and the ATR on this long here you saw earlier, 34.49, 34.48.75. This entry long here, the ATR at the time was it was 2.5, 2.25, 2 points, right? So that's what the market is telling me the distance it could achieve. At that point, it doesn't really make a difference. If you lose a tick, but you're able to get in, it's not the end of the world, right? Because look at how large that value is. You're looking at 8, 9 ticks of profit on this trade. Giving up a tick and getting in, worth it. But if you're going for a smaller target, 2 ticks or 3 ticks, you can't give up a tick on every trade. It'll catch up to you. So you should use a limit order for smaller targets. Larger targets, like in this example here, market if touched or market is fine. Let me know if that clears it up, Jeff. Anybody else have any questions? Terry, Sally? All right. So the type of orders, once again, we have MIT, market if touched. MIT orders basically says, it touches this order, get me in at market. It's always placed below to be a buyer, always placed above to be a seller. So wherever the price is trading, if you left click
Order
and you
submitted.
choose the MIT option, which is you can alternate by holding the control key,
Order submitted.
you're going to get filled at market once it touches this price. Expect slippage, not all the time, but it gets you in regardless.
Order
The
canceled.
limit order is placed in the same exact way. A limit order, the way it works is left click once again, and it says, I want
Order
this,
submitted.
I want
Order
this
canceled.
exact price,
Order submitted.
or better or nothing. The same up here, I want this exact
Order
price or
submitted.
nothing. So they're placed in the same way. Left click, above to sell compared to where the price is currently trading, below to buy. Limit orders and market orders are the same type of order.
Order
Okay, it just
canceled.
depends if you want to get in immediately with or without slippage. The stop order, instead of placing it below or above as a retracement, you're placing a stop order as it goes in the same direction up. So instead of being a buyer here on a limit or market if touched, you're going to be a buyer here. Middle mouse button, hold it down. A stop order
submitted.
says, as the market goes in the same direction, I want to be a buyer. The stop order is used as a protective stop if you're already in, or to enter for the first time into the market. The same thing, as the market goes down, you're using a stop order to get you in for the first
Order
time.
submitted.
Now, if I get filled here, if I'm a buyer,
Order filled.
now this becomes my protective stop, right? As the market goes down, I'm using it as a protective stop. So it's just an order. Don't always think of it as a protective stop. Think of it as just a type of order to get in. And a stop
Order
with limit
filled.
is basically the same as a stop, but you're limiting the amount of slippage. So if you wanted to go long here, but on a stop at this price, but you're limiting it by no ticks, 1 tick, 2 tick, 3 ticks, what you're saying is, I want to get filled within 3 ticks of this price. And that's
Order
what a
submitted.
stop with limit is intended to do. Limit the amount of slippage. And that's important. If you're entering and the market is crazy and volatile, as we've
Order
seen,
canceled.
and you're trying to make heads or tails of it and you don't want to have slippage, use the stop with limit or use the limit order. That way it'll prevent you from getting slippage under the crazy volatile markets. If you don't care about slippage, if you're saying I'm fine with 1 or 2 ticks of slippage, then just use the MIT, or just use the market, or just use the stop. Excellent. Okay, very good. Does anyone have any questions? Any final questions here? I wanted to go over the orders because we get a lot of email, and some traders ask similar questions about order placements and what the orders mean and the type of orders. I just wanted to create a live Q&A session answering questions about the orders, showing you the software as well. Remember, again, November 2nd, we have the next mentorship class that begins, includes all the courses and software at one discounted price. If you do have any questions, though, feel free to email us or call us. If you want to learn more about trading, visit daytradetowin.com. Subscribe to the Day Trade to Win YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software.